At the end of the year, many mutual fund investors receive an unexpected tax bill. Their account balance might look the same as it did a few months ago, but in some cases, it might have even declined. Yet, they still receive a sizable tax form in the mail telling them that they owe taxes on capital gains that they didn't realize they had. This isn't a mistake. It's a byproduct of how mutual funds work, and it can be avoided with the right plan. In this video, I want to go into year-end mutual fund capital gain distributions, why they happen, how they create tax liabilities, and how smart strategies can help minimize that impact. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. So what are capital gain distributions? A mutual fund's capital gain distribution is a required payout of the fund's realized profits over the course of the year. Whenever a fund manager sells a security for more than the fund paid for it, that triggers a capital gain. And by law, mutual funds generally distribute at least 98% of these gains to shareholders each year to avoid fund-level excise taxes. These payouts typically happen in November or December, and they create a taxable event for anyone holding the fund in a taxable brokerage account. Think of your trust or an individual account or even a joint account. As an investor, this tax impact happens whether you sell your shares or you reinvest your dividends or you reinvest the cap gain distribution. It doesn't matter. When that distribution comes out, the IRS treats it as either income or capital gains or a mixture of both. Oftentimes, this can come as a surprise to investors when they didn't necessarily expect a tax bill because they didn't even do anything in their account. The distribution actually gets reinvested as existing shares in the fund that you own. So you don't actually receive that distribution in cash or income, but you're still taxed on it. And one of the most frustrating situations that an investor can land in is when a fund has a capital gain distribution after it declined in value throughout the year, which can happen too. The fund might have sold appreciated stocks that were purchased years earlier, or may have needed to sell long-held positions to raise cash because of other investors that were redeeming their shares. Regardless of the reason, a realized gain inside the fund becomes a tax liability for anyone who owns it. A key distinction to think about is the fund's holding period matters, not necessarily yours. So when most people think about capital gains being short-term or long-term, they think about how long they, as the investor, held onto the investment. But with mutual fund distributions, the tax treatment is actually based upon how long the fund owned that position. So you may have owned a fund for years, but still receive short-term capital gains treatment on a distribution that occurs. And how does that happen? Well, if a fund owned a stock for less than a year, and they sold that stock, it would produce a short-term gain. And that would basically be taxed as ordinary income to you when it gets distributed at the end of the year. On the other hand, if a stock is held for longer than a year and that cap gain distribution comes out after they sold that stock, if you've only held the fund for a short period of time, call it a couple months, that distribution would still be treated as long-term capital gains income. Most large capital gain distributions that happen are generally long-term in nature, but every fund company will issue a 1099 div that will give you the details on long versus short term. The problem with capital gain distributions is that they reduce what investors keep, even when the investor didn't make any changes along the way. So they can push someone into a higher tax bracket, create an unexpected cash obligation, or even reduce the overall efficiency of a portfolio. The most important point to remember is that mutual fund performance and mutual fund taxable distributions are two very separate things. A fund can lose money for a year and still trigger a large taxable gain for its shareholders. And this is why advanced planning really matters. Investors who understand that these distributions are coming and can work to avoid unnecessary bills can secure their returns over the course of time. Here's the first strategy that you can use to potentially help. Use tax-advantaged accounts. One of the most effective ways to eliminate tax impact for mutual fund cap gain distributions is to hold these actively managed funds within a tax-advantaged account, like retirement accounts, IRAs, Roth IRAs. Inside these accounts, all distributions, including dividends, interest, or capital gains, are tax deferred. So the taxes apply later on when the funds are withdrawn in retirement. So for the time being, your investment can keep compounding without any kind of tax burden. This is generally the easiest and most reliable way to minimize this problem. Another strategy is to choose tax-efficient investment vehicles. Some types of funds are more tax-efficient than others and substantially more tax-efficient than traditional mutual funds. Exchange-traded funds, or ETFs, especially broad index ETFs, rarely generate large capital gain distributions because of how they're structured. And when someone sells their shares in an ETF, the sale takes place directly between the investor and the exchange. And it doesn't force the ETF manager to sell underlying securities within that ETF. Because of this, ETFs tend to distribute significantly fewer capital gain distributions. Index mutual funds follow a similar principle since they just track the index like the S&P rather than being actively managed, which are generally the ones that distribute. This makes ETFs and index funds great alternatives for taxable accounts instead. A third strategy that you can use is avoid buying a mutual fund right before the distribution. Buying the dividend is another common investment mistake. This happens when someone buys a mutual fund shortly before it pays a year-end distribution. At this point, the fund's share price will drop by the exact amount of the distribution on that ex-dividend date, and the investor hasn't enjoyed those gains or gained anything. They still receive a tax bill as if they'd earned the profit. I want to give you an example to make this a little bit easier to understand. Let's say an investor, Alex, plans to invest $10,000 in a mutual fund in December. If Alex buys the shares the day before the distribution, he receives an $800 taxable distribution, and the share price drops by 80 cents. His account is still worth the same amount afterward, but now he owes taxes on the distribution. On the other hand, if he'd waited until the day after the distribution, he would have avoided that entirely. So when investing in mutual funds late in the year, especially around October or later, it's really important to check the fund's record date and ex-dividend date. If a large distribution is approaching, waiting a few days will help eliminate that unnecessary tax bill. Something to be aware of also is that sometimes cap gain distributions can happen in the middle of the year, in the summertime. It's always just important to check into the mutual fund's ex-dividend date and any other information that you can find as you do your due diligence. A fourth strategy that you can use is use tax loss harvesting over the course of the year to mitigate the impact of what any kind of cap gain distribution may cause. Tax loss harvesting allows for investors to use losses in their portfolio to offset realized gains elsewhere. This can be especially helpful when capital gain distributions are completely unavoidable. The process is pretty straightforward. All someone has to do is sell a position that is down at a value less than what they bought it for, and that loss can be used to offset a gain somewhere else in their portfolio. If the loss exceeds the amount that they have in gains during that year, they can carry it forward into the following year, but also use $3,000 to offset taxable income by that amount. To avoid missing out on opportunity cost or the growth of the investment that you just sold, usually it's advisable to invest in something similar. That way, if that sector of the market or that area of the economy benefits during the time in which you don't own that fund or don't own that stock, you still are able to benefit and profit from that growth. However, it's really important to avoid the wash sale rule, meaning you have to wait at least 30 days between when you sold that fund or that stock and when you bought it back again, or else that loss is completely eliminated. When buying something that is a suitable replacement in the meantime, you just want to make sure that you avoid the substantially identical security, which more or less means that it can't be just another share class of the same fund, but another fund that from a different fund manager that still focuses on the same sector still would qualify. When done properly, tax loss harvesting can be a really effective tool to lower the tax impact of distributions over time. Overall, year-end capital gain distributions are one of the most common tax burdens for investors. But with the right approach, they can easily be minimized and in many cases avoided completely. Here are the key takeaways that make the biggest difference. First, review your accounts and identify actively managed mutual funds within taxable accounts. Second, consider using tax-efficient vehicles like ETFs or low-cost index funds for those taxable accounts. Third, avoid purchasing mutual funds late in the year without knowing its distribution schedule. Always do your due diligence and check on the fund before you buy. Fourth, look for opportunities before December 31st to use tax loss harvesting strategies to offset any kind of realized gains that you might have or capital gain distributions. Taxes play a critical role in long-term investment outcomes. At Pacific Wealth Management, we work closely with clients to help design comprehensive, tax-efficient strategies that support their goals and provide a clear, confident path to retirement. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth build a real estate portfolio or buy the home of their dreams, be sure to check out our other content at www.pacwealth.com. Thanks.